Welcome to this second lecture of week 5. We will be looking at generally accepted accounting principles and cash flow management. In many countries, the public sector prepares accounting statements as prescribed by the International Public Sector Accounting Standards. In the South African context, public sector accountants follow the prescript of generally recognized accounting practice, whilst their private sector counterpart observe generally accepted principles. GAAP is internationally prescribed to form the basis of much of accounting practices in the public sector. It is a set of standardized conventions developed by professionals in the accounting field. GAAP is developed out of a need to ensure meaningful comparison between collected accounting information. In South Africa, GAAP is used to refer to generally accepted accounting practice as opposed to generally accepted accounting principles. The slight variation in wording used by South African and international accountants may be attributed to legislation in the form of the 1973 Companies Act, which stipulates in its section 286.3 that annual financial statements of a company shall, in conformity with the generally accepted accounting practice, fairly present the state of affairs of that company and its business as at the end of the financial year concerned and the profit or loss of that company for that financial year. Here is how the generally accepted accounting principles look like. As you will see, the left column presents GAAP's disclosure criteria, whereas the right column presents GAAP's qualitative criteria. Most organizations need to keep a minimum amount of cash flow for operating purposes. This cash amount is normally referred to as working capital. It is not a straightforward matter to determine the amount of cash an organization ought to maintain to meet all its current financial obligations. If the organization does not have enough cash on hand, it will fail to meet all its obligations, some of which may prove costly to the organization. The process of working capital management is facilitated by the use of a number of financial management instruments such as the cash flow budget, the statement of resources and uses of funds, and financial ratios. The cash flow budget is a forecast of current and future inflows and outflows of cash set up within a calendar framework or schedule. The statement of sources and uses of funds is much broader in scope than the cash flow budget. It does not focus exclusively on the cash account for evidence of cash flows, but seeks instead to examine all the balance sheet accounts to determine when, where, and or on what the organization's resources have been spent. And finally, the financial ratios can be divided into two: liquidity ratios and coverage ratios. This is how a cash flow budget looks like. As you will see, it presents the scheduled breakdown for the cash flow in monthly, and it covers a 12-month time span. With the cash flow budget, monthly subtotal and yearly totals are given for the following categories of cash flow: cash receipt, cash payment, and net cash um, receipt. The cash flow budget gives an indication of the anticipated amount of cash that will be available at the beginning and end of each month and the end of the year. To close, we have these reflection questions when one would like to know the principle that should be promoted for effective financial management and accounting in the public sector, and what can be done to enable managers to comply with the prescripts of Public Finance Management Act.